Emotional trading and chasing rapid price swings are common symptoms of a misunderstanding of basic market structure. The market operates with a specific purpose, constantly seeking out and absorbing pools of liquidity. Recognizing this purposeful movement allows a trader to transition from guessing direction to mechanically anticipating the next move. This graph shows a fluctuating price range. Top and bottom peaks represent external range liquidity, where stop losses accumulate. Inside lies internal range liquidity, the short-term imbalances. The cycle repeats. Price sweeps an external high, rebalances an internal gap, then expands to the opposing external low. Memorizing this specific sequence of delivery provides a framework for predicting the market's next destination without chasing individual candles. We apply this concept using a 2-time-frame alignment. The 4-hour chart provides the macro bias, while the 15-minute chart offers the precise entry point. On the 4-hour chart, price dips below a structural low, sweeping external range liquidity, signaling a shift in direction. We then target the nearest internal fair value gap above the current price. Establishing this hard target on the 4-hour chart creates a definitive bias, filtering out the noise of lower timeframes. With our bias set, we move to the 15-minute timeframe to locate the mechanical trigger for execution. Look at these 15-minute candlesticks. The trigger occurs when aggressive price displacement punches through a previous down close gap, creating an inverted fair value gap. The entry is mechanically triggered when price retraces back down to retest this newly formed IFG. Waiting for this specific displacement and retracement sequence helps prevent early emotional entries and improves the overall risk profile of the setup. Execution requires a strict mathematical rule. Every trade must offer a minimum 2-to-1 risk-to-reward ratio. By sliding the stop-loss marker to reach a 2-to-1 ratio, the trade reaches a statistical break-even point at a win rate of just 34%. Forcing every setup to meet this minimum ratio shifts the focus from chasing perfect predictions to managing statistical probability. Now that the price has reached our internal target, use the delivery cycle to determine where the market is drawn to next. With the internal liquidity rebalanced, the price is now naturally attracted back toward the opposing external low. We repeat the execution in reverse, move to the 15-minute chart, locate a bearish inverted fair value gap, and set a 2-to-1 order targeting that macro low. Market behavior functions as a continuous, recognizable, and exploitable loop. This macro chart shows the result of stacking cycles back-to-back over several days, following delivery from external to internal and back. By capturing these moves, you compound returns through asymmetric risk, netting 2R and 6R on the reversal, totaling 8R. Mastery involves executing a repetitive model that limits the impact of losses and compounds the weight of wins. We can distill the entire process into a 5-step checklist. Identify the 4-hour sweep, define the target, wait for 15-minute displacement, enter on the IFG retest, and maintain a minimum 2-to-1 ratio. Adhering to this checklist removes individual emotion from the process, turning market analysis into a repeatable business operation.